Being a narrow-minded investor is going to blind you to the risks that are around you and to the opportunities that are around you. And so you need to take a big picture view of your investment activities. Listen to this episode as I guide you on how to have this big picture mindset as you invest. If you've seen a horse, whether in real life or in a movie or something like that, you've probably seen them with black things next to their eyes. And those things are called blinders, and the purpose of them is to help the horse stay focused on what it is doing. For example, if it is racing, it needs to stay focused on the racing and not get distracted by things happening around it. And if it is like pulling a plow, it needs to stay focused on that activity as well. The horse might be narrow focused, but the person who is guiding that horse needs to be aware of the surroundings in order to properly guide that horse to do whatever it is doing. Often, when we are investing, we tend to have that narrow focus when we are picking our investments or doing something related to that. And it is important for us to broaden our focus so that we are aware of the different risks that we might be facing and also the different opportunities that may be available to us as investors. And that is the purpose of this episode. I'm going to guide you on how to develop a big picture mindset as an investor. There are various things that you need to keep in mind as you invest to have this big picture, and we're going to cover them one by one. The first step towards having this big picture mindset is to always think of your investments not as individuals, but as a whole, as a portfolio. And what that will do is it is going to help you make sure that you're not taking on too much risks with each investment that you are taking on. And the way you're going to take this portfolio view is to make sure that you have a balance between the high risk investments that you have in your portfolio and the low risk investments. And what you want to do is to make sure that you are not giving up opportunities to earn high returns. At the same time, while chasing those high returns, you are not taking on so much risk that is, if something major happens, your entire portfolio is going to be wiped out. So you need to have a balance between the high risk investments and the low risk investments. I'll give you an example of how you will go about having this portfolio view of your investment. Let's say you are saving for the education of one of your children, and they're going to need that money about 20 years from now. So when you're taking a portfolio view of that investment, you would split the amount that you're saving between high risk investments and low risk investments. And so at the very beginning of the saving, you're going to put most of your money, let's say 60% of it, into the high risk investment, and then 40% into a low risk investment. The high risk investment could be stocks or something like that, and the low risk investment, it will be typically bonds or something like that. And as time goes by, you're going to move more of your money from the high risk investment to the low risk investment, so that at the end of that saving period, when 20 years comes by, all your money is going to be in the low risk investment. So why would you do that? The thing is, you want to make sure that that investment is growing as much as possible. And so at the very beginning, you're going to put most of your money in the high risk investment to make it grow. However, as time goes by, you want to make sure that that money is safer and safer, so that when you need it, it's going to be all there and you're not going to be worrying about an investment not doing well. So that is why you start off by putting most of it in the high risk, so that it starts gaining returns and it earns high returns over time. And then as you get closer, you move most of it to the low risk investment so that it is safe. And that is how you would approach any other investment that you have. You need to think about what is the balance between the high risk and the low risk investments that you have. The next thing that you need to bear in mind is while you want to make sure that you have a balance between high risk and low risk. You also do not want one specific investment to take up most of your money. When you think about, let's say, a pension fund or any other kind of institutional investor, you will find that when they are investing, they usually put a small amount of their money into any particular investment. Let me give you the example of Berkshire Hathaway, which has been a successful investment company for very many decades. And when you look at their portfolio, you will find that on average, they just invest 2% of what they own in a single investment. And what that means is that if that particular investment fails, they still have 98% of their capital. They are not going to be wiped out by the failure of one investment. Let's say you have a million shillings that you're investing and you take this approach. That will mean that you will invest just 20,000 in one specific investment. And if 20,000 is lost in that investment, then you'll find that you still have 980,000 shillings, and that 20,000, you wouldn't even miss it at all. At the beginning, you'll find that most of your investment capital is going to be concentrated in one or two investments. However, as time goes by, it makes sense for you to start investing in more and more different types of investment vehicles, so that one particular one does not dominate your entire portfolio. That is the first way that you have a big picture view of investing. Have a portfolio mindset. Think about the balance between the high risk investments and also the low risk investment. In addition to that, the big picture means that one investment should not take up all your investment capital. It needs to make up just a small amount of your investment capital, so that in case that one thing fails, you are not going to be wiped out. And so you've taken a big picture view of your investment by having that portfolio approach to your investment activities. The next thing is to have a big picture view in terms of the individual investments that you are going to pick. And the way that you do this is you need to have an industry view of the companies that you're going to be picking. And what this does is it ensures that you are picking industries that are growing, that are going to offer you greatest opportunities to grow your investment. How do you do this? The first one is look for industries that are in the process of growing, which industries are hot at the moment, or which industries are promising to be hot over the next couple of years. There's a saying that is adopted by fishermen and that was made popular by the President JFK of the United States and also later by Ronald Reagan. And what they said was that a rising tide lifts all boats. And what that means is that whenever the sea levels in a particular area are rising, all the boats in that area are likely to also be lifted up. And the way those presidents used that saying is they meant that whenever an economy is doing well in general, then individuals in that economy, families and individual people are also likely to also be doing well. So they were encouraging people to come together and work as a country to build the economy, and what that will do is that individuals will also become prosperous. And that applies to investment as well. Whenever the economy in general is doing well, you'll find that the industries in that country are also doing well. And whenever a particular industry is doing particularly well, then the companies in that industry are also likely to be doing very well. And that is the kind of approach that you would take as an investor. Before you start looking at specific companies to invest, you look at different industries and how they are doing. For example, you look at banking or insurance or manufacturing or any other industry, and you ask yourself which industry at the moment is showing potential for great growth. And then once you've identified the industries that are likely to grow over the next couple of years, then you focus on the companies that are in that industry. And what that will do is that it is going to greatly increase your chances of success as an investor, because you are more likely to pick a winner, so that you do not need to start thinking about the ability of the management to find opportunities. In a growing industry, there are likely to be many opportunities. What the management will just need to do is be able to take advantage of those opportunities. And so by having that industry view of your investment, you reduce the amount of risks that you're taking, and you increase the potential for your investments to grow. And the next thing that you need to think about when taking this big picture view of the industry is you need to have the right management in the companies that you are picking to invest in. And often when you look at a company, there is a lot of information about it, and you might get overwhelmed by all the numbers and all that information. But the most important thing, once you've picked the right industry that is showing growth, is to focus on the management of the companies that you are looking at. What you need to do is have a management that is skilled and that is able to take advantage of the opportunities in that industry. They can create a plan and then expertly execute that plan in order to earn you returns as an investor. And the example I'm going to use right here is the example of a legendary sailor in the 1400s. In the 1400s, if you are able to cross the Indian Ocean and go to India, you are likely to be a very profitable sailor because you will be able to go there and bring the goods to Africa and also to Europe and trade them at a profit. If you had a great sailor, for example, like legendary sailor Ahmad ibn Majid, you will be able to make that trip pretty safely. However, if you do not have an expert sailor, you would end up like thousands of Europeans who died because of wrecks and attacks. And what that expert sailor would do is they understood the weather and they understood the sea, and they knew of how to take advantage of the changing weather and the changing sea conditions in order to sail safely and quickly to the Indies. And that is what an expert group of management does. They understand the industry that they are in and understand the environment that they are operating under. And so they are able to efficiently take advantage of the opportunities that are presented to them. So what you're looking for is management that is, first of all, competent. They need to be ethical. You need to be able to trust them, and they need to be shareholder focused. They need to be focused on giving you returns as a shareholder. And so that is how you have a big picture view whenever you're picking specific investments to acquire. You need to look at the industries that they are in. And once you've narrowed down on an industry that is showing great growth potential, you narrow down on the companies that have the most skilled management. And when you do that, you exponentially increase your chances of being a successful investor, because you are in an industry that is doing very well and you have the right management to take advantage of that opportunity. And one thing we always forget whenever we are investing is to think about how we are going to exit an investment, because without a doubt, whatever investment you acquire, at some point in time, you will need to sell it. And if you lose sight of the fact that you will need to get out of an investment and you need to get out of it in a profitable way, then you'll find that you end up holding investments that are not easy to sell. Let me give you an example. Land is a great investment for most people, and it has been talked up a lot. However, the tricky thing about land is that there are places where you would buy a piece of land and for example, you buy it for 100,000 shillings this year. Then several years from now, you find that it has appreciated to 1,000,000 shillings. And right there you have 900,000 shillings in profit. The challenge usually comes when you try and sell that piece of land for 1,000,000 shillings and you find that it is very difficult for you to find buyers. And if you look through the news, there have been stories in the past where a bank has a huge piece of property that they're selling for billions of shillings, but they are having a very hard time finding a buyer. And it is something that is commonly happens. And for you to find a buyer, either you need to wait for a very long time before you can find someone who's going to give you that amount that you are looking for, or you need to sell that piece of land for a discount. And so when you find that too much of your investments has been put into land that is not easy to sell, you find that you might have paper wealth. On paper, you might be wealthy, but converting that paper wealth into actual wealth becomes a challenge for you. So when you have that exit view of your investments, you avoid such a situation. And it's not just land that can have that liquidity problem. It is the same with different types of investments. There are investments that you cannot sell them and you have to hold them until the very end of the investment period. And so when you have that big picture of investing where you keep the exit in sight, you will avoid situations where you keep investing in things that are difficult to sell in the end. And a rule of thumb that you might have is to avoid or to minimize the investments that you put into non-productive assets. What do I mean by non-productive assets? There are things that you can buy, there are things that are called investments that you can buy, and when you're buying them, what you're hoping to do is that in future they are going to increase in price and then you're going to sell them at a higher price and make a profit when you do that. That investment is not giving you a cash flow or is not giving you continuous returns, but you're waiting for that big return at the very end. And there are other investments where you continue getting, let's say, an interest or a dividend regularly, and then towards the end you might sell it at a profit compared to what you had paid for it at the beginning. So you have those two types of investments. One is a non-productive investment and the other is a productive. What you need to do is focus on the productive investments, and the advantage of doing that is that they continuously give you a return, and even if you do not sell them at a specific time, you continue getting a return from them. And so after a while, even the money that you had put into that investment, you will have made it all back. But the non-productive investment where you have to convince someone to buy it from you at a higher price can be quite difficult for you to sell at the end. And often when you have made a mistake about how easy it is for you to sell that investment at a profit in future, you end up becoming a speculator at best or a gambler at worst, where you start gambling with your money, hoping that you're going to put money into something and then you're going to sell it at a higher profit. But when you focus on productive assets, assets that can be used to do things and generate money, or that can give you interest in the interim, that can give you dividends, then you find that you do not face that problem of being a speculator, and you do not face that risk of failing to find someone to buy it from you in future. So that is the third way that you have a big picture mindset, where you look at the end of your investment and where it is leading, how you're going to exit from it. Do not put too much of your money in investments. Do not put too much of your money in investments that are not going to be easy to exit. And to further reduce that risk, put most of your money in productive assets, assets that are going to give you a continuous return or that can be used to produce some kind of return, rather than assets that you need to convince someone in future to buy them from you for a profit. So those are the three ways that you can have a big picture mindset when you are investing. First of all, have a portfolio view of your investments. Do not focus too much on individual investments, but take a step back and look at how much risk you're taking on in total and how much money you have invested in a particular investment. Then the next big picture view is take a view of industries. Look for industries that are growing, and then look for companies in those industries that have outstanding management. That way, you are likely to significantly grow your investments. And finally, have a big picture view in mind where you do not invest too much of your money in investments that are hard to sell, or investments where you need to convince someone in future to buy them from you at a profit. So when you're investing, do not have a narrow view of things where you can easily be blindsided by risks that you have not anticipated, or you can easily lose sight of opportunities that you could take advantage of. Remove those blinders that might be narrowing your focus and take a big picture view of your investments.